and last week, Pimco made it official. The firm named Neel Kashkari global head of equities. Of course, you know Neel very well. He was a guest on this show. Before he went to Pimco, he was the first head of TARP, the government bailout program for banks. He joins us from Pimco headquarters out in Newport Beach, California. Neel, a lot of people are running for the mountains from equities right now. You're getting into this business. Why is it the right time in this period of volatility?
You know, you're right. Markets are very volatile right now, both because of economic factors and political factors. But we think the outlook for the equity markets for long-term investors is very positive. Remember, equities offer returns in 3 different ways. Multiples can expand, earnings can grow, and through dividends. And on all 3 factors, equities look very attractive today. Look at the S&P 500. The PE multiple is around 12.5 times, which is attractive compared to history. It's offering a 2.25% dividend yield, and large corporations, especially those with exposure to emerging markets, continue to have strong economic and earnings growth potential. If you look outside into the emerging markets themselves, PEs are even lower, PE of around 11 for the MSCI EM index. Dividend yields are around 3%, and again with strong earnings growth. So based on long-term fundamentals, we think equity markets are very attractive. But as you said, volatility is here to stay. So investors need to have a long-term horizon and need to be able to stomach that volatility. But if they do, and if they can, we think they'll be rewarded over the long term.
I'm looking at the VIX here, just about at a reading of 42. What you emphasize that with your global equity portfolios, you try to stress test for worst case scenarios. What are you testing for, and how are you looking for protection? Is it in the options markets? I mean, how are you hedging?
You know, it's a great question, Margaret. Managing downside risk is absolutely critical. It's not good enough to try to beat a falling market. And so we absolutely stress test different scenarios. It could be the developed world having a big recession. It could be a hard landing in the emerging markets. In many of our equity strategies, we embed tail risk hedging into the strategies themselves to try to clip that downside. Now, tail risk hedging, like any insurance, isn't free. It requires careful, active management to try to reduce that cost and clip that downside risk. But we think managing the downside is just as important as picking the right stocks for the upside. They're both critical, especially in this volatile environment.
So those are things like put options?
In some cases, it could be put options on broad market indices. In some cases, it's looking around the globe. So, for example, our emerging market equity strategies may have hedges within the EM equities area themselves, or they may look to develop market hedges, because in times of market shocks, a lot of these uncorrelated asset classes end up becoming correlated. So we look all around the world for hedges, not just those in the individual market that we're trying to hedge itself.
Neel, we're just about to close trading in Europe. I'm looking at the French market down 4%, Germany now down 2%, credit risk an all-time high today. Are we about to see a default?
I think we're getting very close. I think the markets are telling us that kicking the can down the road is finally running its course, and they're not going to allow Europe to just deny and delay much longer. I also think that the fact that European governments, the Germans in particular, are starting to take action to stabilize their own banking sectors, I'm not surprised by that, and I think it's a good thing. I think it's a lot easier politically to ask the German taxpayers to stabilize the German banks than it is to ask the German taxpayers to continue writing checks to the Greeks. So as we see sovereign countries stabilize their banking systems, and as we see the ECB continue to put more risk on its balance sheet, the Eurozone is trying to spray foam on the runway. That's an expression that Secretary Geithner likes to use. Spray foam on the runway to protect the system so that the restructuring can take place. A restructuring of Greek debt and potentially, eventually, an exit of Greece from the Eurozone.
Well, Germany came out with their Plan B, supposedly, but France has yet to tell us that, and yet there are rumors of Moody's possibly downgrading French financial institutions today. What did the French need to do to contain things?
I think you're going to see what happened in 2008 as many individual countries took action to stabilize their banking sectors through lending programs and through capital programs. I would expect to see each of these countries on its own take those similar actions to stabilize their own banks. Again, it's partly driven by politics. It's easier to get your own taxpayers to bail out your own banks than it is to bail out your neighbors. And so I think they'll be able to move very quickly. It's one thing to ask the French people to go to the French legislature to make that decision. It's a very different thing to ask 17 state legislatures to all reach agreement on something. And so I think in the coming weeks, you're going to see individual countries take these kind of steps to make sure that their financial systems are protected in the event of a default or the event of an exit from the Eurozone of one or more countries.
And Neel, are you saying you expect nationalization of institutions?
Not necessarily nationalization, but I expect more of what we saw in 2008, which is many countries in 2008, including the U.S., took very aggressive steps to stabilize their own individual banking systems. I think we're going to see that happen in Europe over the next weeks and months as this kicking the can down the road runs its course. I'm sorry?
Guaranteeing deposits, things like that?
I believe so, yes. Capital, lending, and then guaranteeing deposits.
Jamie Dimon, getting a lot of attention for strong statements, as he often makes, said today that he expects that, he's on the verge of saying the U.S. should withdraw from Basel because he thinks U.S. financial institutions are treated unfairly. He's talking about capital requirements. Do you think they are?
You know, hard for me to know. I think that there's no one perfect regulatory scheme where every bank in every country is going to be treated equally fairly. I'm sure that Jamie Dimon is talking about what's in J.P. Morgan's interest, and I think that we need to have regulations that are global in nature and not simply national in nature. So hard for me to agree with him.
Neel, thanks for your time. Good luck with the business.